Welcome back to Retirement Coffee Talk with Sharice Rivers at Zinnia Wealth. Our website is zinniawealth.com, Zinnia wealth.com. As you're listening to the show, I invite you to go to the website and tool around a little bit. As you go to the navigation bar up at the top, there's an education button there, and when you hit it, there'll be a drop down, and it'll say useful guides. There's so much stuff there that you can download about 401ks and pensions and Social Security and Medicare and all sorts of different topics that you probably will find interesting as you're getting ready for retirement. Again, that's zinniawealth.com. All right, recently we did a story about the popularity of dividend-paying stocks. It was interesting because as baby boomers get into retirement, annuities have been selling at record numbers. And then when the interest rates went way up, CDs were selling at record numbers, obviously, because the interest rate was up. You're getting more for your money. Now, dividend-paying stocks are doing very, very well. Well, it's interesting here. The Mag 7, which we hear about all the time, all those tech stocks, some of them have dividends, some don't. This article says, watch out for the suspicious 8. And these are companies that have dividends, but their dividends are so high that it's a little bit of suspiciousness going on here. And the names here, Sharice, UPS, ConAgra, Kraft, Pfizer, Verizon. These are really well-known companies, and they have dividends at 6 and 7 and 8 and even 10%. You talked about that a couple of weeks ago and said this is a warning sign. Does this bug you? I mean, are you using some of these, or have you used some of these?
Yeah. So for first-time listeners, and if you're not following the Mag 7, this to give you context, that's Alphabet, Amazon, Apple, Meta, Microsoft, NVIDIA, and Tesla, right? This is where a lot of people hang their hat and just it's growth, growth, growth. But there's times where some of those aren't growing, but then there's times where there's sectors like the change and or large cap versus small cap or mid cap growth does better than others. And right now there's a go-to for large cap dividend stocks, right? But you also have to look at the buyer beware behind it. So just because your neighbor says, hey, I am buying Verizon because there's a 7% dividend and I have the cell phone and they're never going anywhere, does that mean you go buy it, right? And full disclosure, I'm going to pick on 3 companies. I'm going to pick on Verizon, Kimberly-Clark, and Procter & Gamble. All companies you guys are like, oh, she's going to pick on those 3? Yeah, I'm going to pick on them because I've been following them for years and they have been in my portfolio, but I've really just taken them out because they aggravate the tar out of me and for reasons that we're talking about, this dividend. So when you're talking about a dividend, you're either got a company that does not pay a dividend and you're going to have, sky's the limits growth, and or you're going to have a company that pays a dividend and we don't have as much growth. So for example, Verizon, if you look at the charts, especially the last 5 years, it has paid between a 5 to 8% dividend. Well, that tells you dividends are not guaranteed. So if you bought that dividend at a time period where it was paying 7.5% and all of a sudden now it's 4.5 or 5%, and you were counting on that money for income, you have to start thinking differently because now you got to go to another source to get that income. And or you're selling that dividend stock that went from 7% to 5% dividend to go buy one of these other stocks that are paying a 7% dividend. But how much of a loss do you have to take to sell Verizon at the wrong time to go hop and jump and skip on over to another dividend stock, right? So I've seen so many people do this over time. So number 1, dividend stocks are not guaranteed. Number 2, I do like dividend stocks, and we do have a dividend stock portfolio that does quarterly trading, right? When something's not paying what we want it, we get out of it, we go into something better, but without taking a loss. There can be a trade-off sometimes. For example, Kimberly-Clark, everybody's got to blow their nose and, everybody has babies and you guys know the rest of the story.
Yes, we
all
do.
need tissue for something, right? Kimberly-Clark, same thing. I just officially said a while back, I am done with Kimberly. I'm out of here because it doesn't pay a high enough dividend, in my opinion. If it fluctuates between 2.2 and 4.2%, and the stock is still sideways for the last 5 years, That for me, my clients are like, Charisse, okay, so we get this dividend, but the growth isn't there and it goes up and down and it's sideways for 5 years. Should we really have it? Even though that dividend gets reinvested back into another Kimberly-Clark stock, for example, buys another stock, but at a 2.5% dividends, might take a while to buy that stock, right?
So what you're saying, let me stop you just a second here. So for instance, if the stock were at $40 a share and you're getting a 4% dividend, and then the stock goes down to $20 a share and you get reinvested, you're now buying a stock at a lower price.
Which I'm fine with. And I like those ebbs and flows because now you're buying another share of that stock that pays you another dividend.
Okay.
Right. So it's kind of, in my opinion, it's a slow and steady way to invest. But for the people who need it for income that are not reinvesting it, it's trouble. It's troubling. Do you know how many people that used to come to me and it's like, oh, my advisor has me on these dividend stocks and my income has gone down $3,000 quarterly. For anybody's income to go down $3,000 quarterly because they didn't have a diversified portfolio, and now they got to figure out they've got to sell the stock that may be at a loss. You are changing the way you've always invested. Financial conventional wisdom: never sell when the market's down or the stock's down. But yet you got a forced hand because the dividend's not paying you the income you need, right? So you have to think through these things. And I'm a fan of having some of these things. But when it comes to these dividend stocks, which I think is the suspicious 8 that you were questioning, Randy, is that they're paying a high dividend. A good dividend company on average pays between 3.5% and 4.5%. Those companies that do that on average have more consistency on their dividend. Therefore, we don't see it change. So if a client wants income, I'm going to go to the companies that consistently pay that 3.5%, 4.5%, because I know those checks are always going to arrive if they need it for income.
So I hear this term aristocrat dividend stocks. Is that what you're talking about here? Ones that are consistent and have been over the years?
Yeah. So that's a great one, right? Which is still not perfect, but we want consistency. And when you buy, for example, Verizon and the dividends at 7%, you have to ask yourself, well, why are they paying a 7% when AT&T is only paying 4.5%, right?
Or if it's a high-flying tech stock, maybe they have a 10% dividend, and then you kind of go, these people just need money to keep going.
It's trouble's knocking.
Yeah.
Trouble's knocking.
Yeah.
And then therefore you can see that the stock over the last 5 years hasn't developed. Neither has their customer service. Another story.
Yeah.
So
there's a story behind that story here. I'll get that one off the air, folks.
Yeah. Kimberly just disappointed me during COVID because there wasn't enough toilet paper around. So there's another story. I got a story for a story. I've been around long enough. But let's talk about the last story, Procter and Gamble. You guys are like, she's going to pick on like this glorious staple of our world, Procter and Gamble. Yeah, I'm going to pick on you, Procter and Gamble.
Laundry soap. Come on.
I love my laundry soap, and I love all the products that they make. But come on now. Here's the deal. Here we go. You ready? If it's paying a 2.5% dividend, for example, and the stock 5 years ago was $149, and 5 years later it's $141, Houston, I feel like something's upside down and backwards here, right? And over the last 5 years, it did jump up to 179, and all of you are like, yeah, it did amazing. And for a very short amount of time, and then it came right back where it's supposed to be, I guess, in the 140s. I'm telling you, when you're looking at your portfolios and you're with your advisors and you have the wrong stock set up in your portfolio and you're wondering why the market's going up, but yet your accounts are going down, it's because the type of funds that you're invested in. So you got to look at the history of this fund and its capability. And lo and behold, if you look at the Procter & Gamble's and these Kimberly-Clarks, they have these run-ups. But since 2019, they've never been able to adjust and arrive back into this game because things are changing since COVID. And with change, you have to change, and your investment strategy have to change. And you can't just go buy Colgate anymore and Procter & Gamble stocks. And you got to be a little bit more diversified.
The idea that you're going to sit down and buy 2 stocks and that's going to, power your retirement is probably not going to be what you're going to need.
I don't want you stroking out on a bad portfolio in my office.
Let's just have purpose for our money. That's what we want to do. This is going to do this. This is going to do this. And this is going to power my retirement. Let's have that kind of a plan for you. And we would love to have that conversation and start down that road.
Thanks for listening to the Retirement Coffee Talk podcast. If you have questions or would like to begin the process of building a tailored preferred retirement plan, call Zinnia Wealth at 833-368-3680 or find us online at zinniawealth.com.
Investment advisory services offered through Zinnia Wealth Advisory, LLC, a registered investment advisor. The firm only conducts business in states where it is properly registered or is excluded from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Insurance products are offered through Zinnia Wealth Management, LLC, Florida license L078655, and Charisse Rivers, Florida license P037744. Zinnia Wealth Advisory, LLC, and Zinnia Wealth Management, LLC are affiliated entities. The information presented is believed to be current. It should not be viewed as personalized investment advice. All expressions of opinion reflect the judgment of the presenter on the date of the podcast and are subject to change. The information presented is not an offer to buy or sell or a solicitation of any offer to buy or sell any of the securities discussed. You should consult with a professional advisor before implementing any of the strategies discussed. Any legal or tax information provided in this podcast is general in nature. Always consult an attorney or tax professional regarding your specific legal or tax situation. Any client experience discussed on this show are unique to that client. Annuity and life insurance guarantees are subject to the claims paying ability of the issuing insurance company. If you withdraw money from or surrender your contract within a certain time after investing, the insurance company may assess a surrender charge. Withdrawals may be subject to tax penalties and income taxes. Persons selling annuities or other insurance products receive compensation for these transactions. These commissions are separate and distinct from fees charged for advisory services. Insurance products also contain additional fees and expenses. Social Security rules and regulations are subject to change at any time. Always consult with your local Social Security office before acting upon any information provided herein. References to specific investments should not be construed as being past specific recommendations. The returns for various indices discussed in this podcast do not represent the performance of the firm or any of its advisory clients. Returns do not reflect the impact that advisory fees will have on an investment. Past performance may not be indicative of future results. All investment strategies have potential for profit or loss. Different types of investments involve higher and lower levels of risk. There is no guarantee that a specific investment strategy will be suitable or profitable for an investor's portfolio. Historical performance returns for investment indexes and or categories usually do not deduct transaction and or custodial charges or advisory fees, which would decrease historical performance results. There are no guarantees that a portfolio will match or outperform a specific benchmark. Investments in fixed income products are subject to liquidity risk, market risk, index rate risk, credit risk, inflation risk, purchasing power risk, and taxation risk. Because bond prices fluctuate continually, their yields change constantly.